If you run a brick-and-mortar retail store, there's this hidden cost that's constantly shaping your business, whether you realize it or not. Think of it like a quiet tax, and it's eating away at your bottom line every single day.
So, what makes up this tax? Well, the first part is the most obvious one, right? Theft. It's what everyone's mind jumps to when you think about retail loss.
But, of course, it doesn't stop there. You've also got to account for all the goods that are just damaged. You know, broken, spoiled, whatever. Stuff that never even gets a chance to be sold.
And finally, there's simple human error. These are those costly administrative mistakes, miscounts, pricing errors, you name it. It all adds up big time. So when you take all these little leaks, the theft, the damage, the errors, and you put them all together, what's the grand total? We're talking about a staggering $112.1 billion annually. Just wow.
And that massive number, it isn't just some figure on a spreadsheet. No, that's what we're calling the quiet tax. It's this unavoidable expense that pretty much every retailer is forced to pay, one way or another. Now, the official industry term for all this is shrinkage. It's basically the gap between the inventory your books say you have and what you actually have on the shelves. And let me tell you, it is one of the biggest silent profit killers in the entire retail industry. But here's the thing. The real problem isn't actually the shrinkage itself. It's how most businesses try to fight it. The standard playbook for dealing with this has a huge hidden flaw. This slide just says it all, doesn't it? Your security measures, they're aimed at the thieves. But who ends up paying the real price? Your best customers. The honest ones. They're the people stuck waiting for an employee to unlock a case or just dealing with a frustrating, high-friction shopping experience. And this creates what we call the dual leak problem. See, while you're scrambling to plug the leak of inventory going out the back door, you're actually creating a second and, honestly, a much more damaging leak. You're losing your best customers out the front door, all because you're making their lives harder for a problem they had nothing to do with. So, yeah, the old approach, it's completely broken. It basically forces you into this impossible choice. Either you accept losing inventory, or you accept losing customers. To get out of that cycle, we have to start thinking in a completely different dimension. To show you what I mean, let's look at a classic brain teaser. How do you arrange 6 matchsticks to make 4 triangles? Now, if you try to solve this on a flat table, a 2-dimensional surface, it's impossible. The only way to get it done is to think in 3D and build a pyramid. Solving the shrinkage problem needs that same kind of leap in thinking. So what is that third dimension for retail? Well, it's a concept called gamification. It's all about taking the things that make games so addictive and engaging and applying those psychological principles to solve real-world business problems. The engine behind gamification is actually really simple. It works because it taps into things we're all wired for as humans. Our desire for instant feedback, the motivation we get from friends and social connection, and, of course, our natural attraction to things that are just plain fun. So, why is this kind of unconventional approach so incredibly effective? It all comes down to the psychology of human motivation and engagement, which has been studied for decades. This quote right here, it just nails it. Modern video games have absolutely mastered intrinsic motivation. Instead of forcing you to do something, they create this whole environment where you want to set and achieve your own goals. That feeling of ownership, it's incredibly powerful. And we don't have to guess if this stuff works in the real world. The top-tier mobile gaming industry has already perfected this entire model. They've literally turned the psychology of engagement into a science, building systems that are absolute masters at converting a user's attention into real revenue. Okay, so let's translate that psychology into a rock-solid business case. This isn't about hoping for the best. It's about applying a proven financial model to the customer base you already have. Let's really look at the numbers here. Just look at this comparison. It's night and day. A typical digital marketing campaign, you'd be happy to convert maybe 1 to 3% of your audience. But the monetization model in mobile gaming, it's a whole different ballgame. It consistently converts anywhere from 10 to 19% of active users into paying customers. The difference is just, it's huge. So, let's apply this directly to a retail business. If you can get just 1,000 of your existing customers to become active players in a branded minigame, you can expect between 100 and 190 of them to make new purchases. Now scale that up. Imagine you have 50,000 customers playing. You're now looking at up to 9,500 new transactions. This is a brand new, passive revenue stream built from the people who already know and trust you. Now, I know what you might be thinking. Okay,
This sounds powerful, but it must be super complex and expensive to implement. Actually, the entire process is designed to be the exact opposite. It's shockingly straightforward and fast.
The whole thing is lean and aggressive. It kicks off with a single discovery call where we figure out your specific needs. From that conversation, we can design a custom-branded digital asset in just 48 hours. And the full build and launch, we're talking as little as 2 to 4 weeks.
And here's the absolute best part. This isn't another line item in your expense column. It's a self-funding asset. It's engineered from the ground up with multiple revenue streams, from in-app purchases to direct orders, that actually drive foot traffic into your store. The entire system is built to generate profit from the very first day it goes live.
So at the end of the day, we're not really talking about selling a game. We're talking about a powerful financial tool. It's a proprietary digital asset with one clear purpose: to be a loss absorption mechanism. It creates a new passive income stream specifically designed to cancel out that quiet tax of shrinkage.
So really, it all boils down to this. That quiet tax is real, and right now you're paying it with lost inventory and, even worse, lost customers. The only question left is whether you're going to keep letting those losses control your bottom line or if you're going to choose to actively absorb them instead. You're already paying the tax. Isn't it about time you decided how?